little piece of history to start today. In 2017, one of the most substantial tax legislations passed. It was the Tax Cuts and Jobs Act. Decades had gone by without this type of legislation that was going to impact individuals, businesses, and corporations. However, all things must come to an end. And at the end of 2025, the Tax Cuts and Jobs Act that was put in place in 2017 is going to sunset. Bye-bye. It's going to vanish. Poof. Unless there's some sort of government intervention. But we're not going to talk about the intervention today. We're going to talk about what is going to revert back when it sunsets, what numbers are going to change back, and some planning opportunities with the new numbers. So, without further ado, let's get into it. All right, I got this great little guide. Let's go through it. On the left-hand side, the gray column is the current Tax Cuts and Jobs Act numbers. On the right, this is the post-Tax Cuts and Jobs Act numbers. And we're just going to start from the top. We're going to work through it. We're going to go through some of these. I'm going to highlight them. First thing is the ordinary income tax brackets. You can see here with the ordinary income tax brackets, currently, there's going to be some big changes in the 22 to 24 and 32% range, where these are actually going to start changing over here on the right-hand side to the 25, the 28, the 33. And then at the very, very top, for the very few of you that do have this type of bracket, the 39.6% new bracket up from 37% now. Trust brackets are also going to be changing. And remember, these are graduated brackets, especially ordinary income tax brackets. Where this fits in is what's called your marginal bracket, where your next dollar will be taxed. So let's say currently you make $383,900. All that money's in the 24% tax bracket between $201 and $383. But let's say you make $385,000. The next $1,100 is going to be taxed at 32%. So your next dollar is going to be taxed at a higher bracket. As of right now, long-term capital gains rates brackets are going to stay the same, but the next big change is the standard deduction. One thing that happened with the Tax Cuts and Jobs Act that kind of splits off into two parts is one, the standard deduction became very, very big. So when you're filing your taxes, the deduction that you would take, you could either do an itemized deduction or take the standard deduction. Most people take the standard deduction because it's so high. It was essentially doubled with the Tax Cuts and Jobs Act. Also with the Tax Cuts and Jobs Act, the exemptions for personal exemptions went away. The personal exemptions are coming back and the standard deduction is being split in half. You're like, oh my gosh, that's terrible. That's going to affect me. Well, it might. For a small family, this could be an issue, but not necessarily. We'll get into that here in a little bit when I start talking about planning opportunities. They are bringing back with the personal exemption, the phase out range, the PEP. Some other things that are coming back are state and local tax deduction can be unlimited where it has been $10,000. Mortgage interest can be itemized now on up to $1 million of loan. Charitable donations and cash go down. Deductibility of financial advisory fees, ding, 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 ding. That's kind of a cool one that might come back. And the P's limitation threshold kind of plays into the personal exemption where if you make too much money, your personal exemption will be reduced. Child tax credits are going to go down a little bit, which, what can you do? If you're a retiree, you don't get those anyway. And then the AMT brackets will be changing. And just AMT is a separate calculation for your taxes. When you file your taxes, you do your traditional calculation and there's an AMT calculation. Most of us end up using the traditional calculation, but if you have like incentive stock options, the AMT may come into play. And then the last really, really big one is the estate and gift lifetime exemption that you can see here at the bottom. $13 million per person is what it is now, which is essentially $26 or $27 million for a couple, is basically going to be cut in half. And what this means is if you're married, let's just say you're married, you and your spouse, you each get your own amount. If you have more in assets than these amounts, you're probably going to have to pay the estate or death tax is about 40% of any amounts above these numbers. So pulling this number back 50% could be a substantial impact into your estate planning. And if they don't make any changes with this, you better start digging into some big estate planning if you've got a big net worth. Also, if you want this guide, feel free to reach out to me. Hit me your email below. I can email this directly to you. All right, so now we're going to go over a few planning opportunities as we work through this. I'm going to try to leave these numbers up so you can see conceptually what I'm talking about. Okay, the first thing I want to focus on as far as planning is the standard deduction. This is going to benefit large families. If you're thinking that the Tax Cuts and Jobs Act, when it sunsets, you're going to be paying more in taxes, in some situations you might be, because the standard deduction is going to be cut in half. But the personal exemptions may help boost that up. So in some situations, when you take the standard deduction and you get the personal exemptions, you actually may be pretty dang close and you may not owe as much in taxes. But for some of us, you definitely will. So if you don't use the standard deduction, you start to itemize, there are some more opportunities to itemize. State and local taxes are unlimited. That could be a pretty big boost on your itemization list. The mortgage interest, since housing prices have become so expensive, that could help as well. The next opportunity is for small businesses, things like partnerships, S-corps, sole proprietorships. You're probably going to see an increase in tax ramifications because of the QBI deduction. If you look at your tax return, you get a nice deduction of potentially 20% of the qualified business income will be deducted off of your tax return. It's been a huge advantage to small business owners. That's going to go away. So your taxes could increase if you're a small business owner. Another planning opportunity is deciding between traditional retirement accounts or Roth retirement accounts. For example, if we think these tax brackets are going to revert to these new percentages, maybe you want to start converting money from your traditional accounts to Roth accounts, because you're going to be in lower tax brackets now than when you may be in the future. But you need to evaluate when you're going to be using the money and if you're going to be in a higher tax bracket then versus now. But you can start to plan if new brackets are going to be coming out, whether or not you want to take the deduction now or the deduction later. Now, just a second ago, I spoke about Roth conversions, but what about traditional contributions? You can still do traditional contributions, especially in retirement accounts like at work, because there's no income limitations. But you can maybe decide, oh, we're in lower tax brackets now. Maybe I should contribute to Roth now instead of taking the deduction now, because I may be in a larger tax bracket in the future. But that's where the planning component comes into play. And then lastly, I kind of touched on this before, is the estate and gift lifetime exemption amount. You can start taking advantage of this in a couple ways. One, you can start gifting assets to get them out of the estate using the annual exemption amount, which is $18,000 now. And you can give $18,000 to any amount of people, and you don't have to worry about paying as much in future estate taxes because you're getting more out of the estate earlier. You can gift huge chunks of money, especially with gift splitting if your state allows it, where you and your spouse could essentially pile those together and give $36,000 to one kid, $36,000 to another kid, $36,000 to a grandkid, and you're starting to remove these assets out of the estate because you start to exceed those annual exemption amounts. It starts to reduce down these numbers. So basically, if you give $100,000, you can subtract down $6.8 million into $6.7 million. And that brings $100,000 back in to the future taxability of the estate. But if you start sending these chunks under the annual exemption amount or gift splitting, so adding them together, you can start sending a ton of money out of the estate to avoid any future taxation. And then just to reiterate the itemization of deductions, I think a lot more people are going to start to itemize. They're going to have potentially more options. So I don't know if it'll end up you'll be paying more or less in taxes after the adjustments because the tax brackets will change, but maybe you'll itemize, but then you'll get the personal exemption. There's a whole variety of things that could come into play. So don't be too concerned, but I think you should start to plan around how this may affect you in the future. This is a part of good retirement and financial planning. If you need help with stuff like this, working through how the Tax Cuts and Jobs Act may change your situation, feel free to reach out to me. I'll be happy to help. I'm Thatcher Taylor. We'll see you next time. Once again, I'm Thatcher Taylor, founder of ProPath Financial and certified financial planner. If you're interested in seeing how we help our clients or implement these strategies that you saw in this video, please go to ProPathFinancial.com. That's www.ProPathFinancial.com to learn more, and make sure to say hi to me while you're there. We'll see you next time.